Welcome to today's Explainer. Look, if you've spent any time at all on commercial construction, you know for a fact there can be this massive, sometimes frustrating gap between the physical reality of a muddy job site and the very clean numbers sitting on a financial controller's desk. Well, today, we're doing a peer-to-peer deep dive into work in progress, or WIP accounting. We're going to build a bridge together. We're taking that hard-earned, practical knowledge you already have from running sites, and we're mapping it to the precise accounting vocabulary you need to reflect that reality on the balance sheet. Think of this as your ultimate whiteboard blueprint for construction finance.
So, here is our game plan for today. We'll start with core WIP terms, then look at the monthly rhythm, dive into the asymmetry hook, walk through Bill and Bob's story, and wrap it all up with the WIP cheat sheet. Let's get straight to it.
Section 1. Core WIP terms. The language of the job.
Okay, so you already know how to build, right? We're just mapping that existing knowledge to the ledger, so you can speak the exact same language as your auditors, your board, and your bank. The foundational concept here is work in progress. I want you to visualize WIP as this massive temporary bucket. Every time you incur a cost, subcontractor invoices, materials, labor timesheets, boom, they drop right into this holding area. They sit there on the balance sheet as an asset. They absolutely do not hit your profit and loss statement until a job is actually completed, or until you've sufficiently billed for that specific progress. It's essentially just a waiting room for your costs.
Now think of the billing dynamic like a giant set of scales. On one side, we've got underbilling. This happens when your team is put in the hard yards, the materials are installed, but hey, the progress claim hasn't actually gone out yet. You've earned more than you've claimed. That makes this an asset because the client owes you for that work. On the flip side of the scale is overbilling. This is when you've invoiced ahead of the actual physical work completed on site. Because you now effectively owe the client that physical labor, overbilling tips the scale straight into a liability.
And here we have what is arguably the ultimate partnership in construction finance. On one hand, you have percentage of completion. This is purely the project manager's physical assessment of the site. It is the crucial, absolutely irreplaceable input. On the other hand, you have recognized revenue, which is the accountant's financial calculation based entirely on that percentage. If the PM gets the percentage wrong, well, the accountant's revenue engine breaks down completely. The ledger relies 100% on the hard hat.
This partnership builds directly into our next critical pairing, the estimate to complete versus the job margin. You have to remind your teams constantly that the ETC, that exact cost required to finish the job, belongs completely to the PM. It's their data, they own it. The resulting job margin, however, is the output. That's the number that tells the entire business whether that job was actually worth winning in the first place. The ETC is the cause, the job margin is the effect.
Moving on to Section 2. The monthly rhythm. Your operational calendar.
So here is your continuous four-step loop. And notice that step 1, right out of the gate on day 1 of the new month, is reversing prior accruals. You absolutely have to pull out last month's under and overbilling entries. Actually, scratch that. It's not just a have to, it's essential for survival, because it allows you to start the month with a totally clean ledger. Then, mid-month, you run your normal billing. At month end, you sit down for that critical review with the PM for their updated costs. And finally, you post the fresh WIP journals. Rinse and repeat. Never, ever break the loop. Section 3. The asymmetry hook. Profit versus loss. This is where things get really interesting. For profits, we essentially have a gradually climbing staircase. As you complete 10%, then 20%, then 50% of the job, you slowly get to recognize that profit. But for losses, oh man, it is a sudden, immediate drop off a cliff. If the math shows a job is going to lose money, accounting principles, specifically the conservatism principle, dictate that you must recognize the entire foreseeable loss immediately. We never, ever defer bad news. So, when a foreseeable loss is detected, you don't slowly drip that pain out over the remaining months of the project. No way. The profit and loss side takes a massive, immediate hit for the full expected loss. And simultaneously, over on the balance sheet side, a heavy liability provision bucket is instantly filled. Profits wait, losses absolutely do not. Let's see this in action in Section 4, Bill and Bob's story, a real-world Docklands fit-out. Okay, so the job kicks off in January. Bob, our project manager, goes out and buys 120 grand worth of specialty glass and joinery up front to lock in his pricing. Good move. Instead of this immediately hitting the P&L, Bill, our financial controller, rightly parks this on the balance sheet as a prepaid asset, and he'll release it slowly over the life of the job.
By February, the billing team pushes out a front-loaded progress claim to get ahead on cash flow. This creates our first temporary overbilling situation. And by March, Bob calls the job 50% complete. Things are looking fantastic. Now, this dynamic brilliantly illustrates the commercial reality of front-loaded billing. Because they invoiced for work that hasn't actually been built yet, Bill has to step in and temporarily reduce the contract revenue on the P&L. He shifts that money straight into a deferred revenue liability bucket on the balance sheet, and it just stays there, holding steady until Bob's actual physical site work catches up to the invoices.
But then in April, disaster strikes. A delivery truck backs right into the building and destroys 15 grand worth of that installed specialty glass. It's a mess. In May, Bob's crew has to work in absolute overdrive, pushing the physical work way ahead of the billing, which creates a massive $90,000 underbilling asset. Finally, in June, they achieve practical completion. The client signs off, but as is standard practice, 5% retention is withheld for the defects liability period.
Let's zoom in on that glass incident for a second, because it perfectly showcases that asymmetric principle we talked about earlier. Back in April, Bill is forced to recognize the full $15,000 replacement cost on the P&L immediately. He knows for a fact they have insurance, but he cannot book the recovery yet. He has to wait all the way until June, when the insurer formally accepts the claim in writing, to finally recognize the $14,000 recovery. You take the hit today, you wait for the written win tomorrow.
All right, Section 5, the WIP cheat sheet, translating the site to the ledger.
So, the crucial takeaway here is this. WIP is simply a holding area for costs. The project manager's percentage complete drives the entire financial schedule. Recognized revenue is strictly about the physical work done, not the invoices sent. And underbilling and overbilling, they're just the weights that balance the scale between the physical site and the financial accounts. Like we said, you already know the jobs. This just gives you the precise accounting translation.
Just quickly, wrapping up the core mechanics for you, the PM's estimate to complete is the trigger for all forward-looking math. Foreseeable losses, we know this now, they are booked immediately and in full, never spread them out. Retentions are money you've already earned, they're just held back as a separate asset. And variations must be treated extremely conservatively. Unless approval is highly probable, leave them out of your revenue.
I want to leave you with a final thought to take back to your own management accounts today. Take a hard look at your spreadsheets and ask yourself, does your current WIP schedule actually reflect the commercial reality of your sites? If it doesn't, take these whiteboard concepts, go sit down with your project managers, and start asking better questions. Because in construction finance, a truly accurate ledger is the ultimate blueprint for a profitable business. Thanks for joining us for this explainer.